The most dangerous phase of a financial revolution is the moment when everyone finally agrees it's happening. Right now, the retail market is entirely convinced that the only way to build wealth in this decade is to buy artificial intelligence. They are buying Nvidia, they are buying Microsoft, they are chasing the momentum of the Magnificent Seven at absolute all-time highs. They are doing exactly what the machine wants them to do. They are providing the exit liquidity. While the public fights over the last few percentage points of upside in the semiconductor trade, the smartest money on Wall Street, the algorithmic desks, the sovereign wealth funds, the institutional giants, are quietly stepping out the back door. They are not leaving the AI narrative. They are simply rotating to the layer beneath it. A layer that is significantly cheaper, far less crowded, and absolutely critical to the survival of the entire global technological infrastructure. Welcome to the Institutional View. Today, we are decoding the silent capital shift known as the AI Capex Rotation. We are going to look past the flashing screens of the tech sector and dissect the billions of dollars flowing into the unglamorous, physical assets that are about to hold the global economy hostage. If you understand what is happening right now, you will stop chasing the software and start buying the concrete. But the true scale of this rotation goes much deeper than just data centers. There is a secondary derivative trade happening in the private markets right now that the mainstream financial media completely missed, and we are going to break it down. First, we have to understand the illusion of the current market. To understand institutional capital, you have to understand the concept of priced for perfection. When a company like Nvidia or Broadcom trades at its current multiple, it implies that the future will unfold flawlessly. It implies endless margins, endless demand, and an endless supply of the physical resources required to build out their vision. Retail investors look at a chart moving up to the right, and they see momentum. Institutional investors look at that same chart, and they see asymmetric risk. The upside is mathematically capped by the law of large numbers, while the downside is a bottomless cliff if even one earnings report misses expectations by a fraction of a percent. This is why you are seeing a massive discrepancy in the 13F filings. The public filings, the mandatory disclosures of what the billionaires are buying and selling, tell a very specific story if you know how to read the data. The smart money is trimming their megacap tech exposure. They are securing their profits. And they are rotating those billions into a sector that hasn't seen this level of institutional demand in 40 years. The infrastructure supercycle. Think about the biological reality of artificial intelligence. It is not magic. It does not exist in the ether. It is a physical, thermodynamic engine. A standard Google search requires roughly 0.3 watt-hours of electricity. A single query on ChatGPT requires nearly 10 times that amount. Now, multiply that by billions of users and factor in the training of next-generation models that require hundreds of thousands of GPUs running simultaneously. 24 hours a day. 7 days a week. The bottleneck of the artificial intelligence revolution is not the processing power. It is not the microchip. It is the power grid. The current global electrical infrastructure was built for the 20th century. It is fragile, it is aging, and it is mathematically incapable of supporting the energy draw required by the projected data center build-outs of the next 5 years. This is the ultimate choke point. And in global finance, whoever controls the choke point commands the premium. This brings us to the first pillar of the Capex rotation, the new monopolies. Institutional capital is flooding into utility companies, energy producers, and nuclear power operators. For the last decade, these stocks were considered dead money. They were boring dividend plays for retirees. Not anymore. Data center operators are currently approaching nuclear power plants and utility companies with blank checks. They are offering to buy 100% of the electrical output of entire power stations for the next 20 years at premium rates. They are bypassing the public grid entirely to secure dedicated power. If you are an institutional investor looking at this dynamic, the math is blindingly simple. You do not need to guess which software company will win the AI war. You do not need to bet on OpenAI versus Google versus Anthropic. You simply buy the toll booth. You buy the entity that generates the electricity they are all desperate to consume. But buying an energy stock is just the first layer of the trade. The smart money is moving deeper into the specific materials required to bridge the gap between the power plant and the processor. Which leads us to the second pillar, the great copper squeeze. You cannot transmit electricity without copper. You cannot build a data center without massive, highly conductive cabling. You cannot upgrade the aging power grid without millions of miles of new industrial wire. The world is currently heading toward a structural deficit in copper supply. New mines take an average of 10 to 15 years to discover, permit, and bring online. You cannot simply print copper the way a central bank prints fiat currency. The institutions know this. They are looking at the supply-demand curves, and they realize that the physical reality of the Earth cannot support the digital ambitions of Silicon Valley. The commodity itself is about to become the most valuable real estate on the board. When you track the money flowing into global mining conglomerates and infrastructure ETFs, you aren't seeing speculation. You are seeing a calculated, long-term hedge against a physical supply shock. They are buying the raw materials of the future before the tech companies realize they are out of runway. But as the power demands increase, another problem arises. A problem that is creating an entirely new multi-billion-dollar subsector within the AI rotation. Thermodynamics. When you pack thousands of advanced GPUs into a server rack, they generate heat. An incredible, unmanageable amount of heat. Traditional air cooling systems, the massive fans that have kept data centers running for the last 2 decades, are no longer sufficient. They consume too much electricity and they simply cannot cool the silicon fast enough to prevent thermal throttling. The institutional rotation has identified liquid cooling infrastructure as the next hypergrowth vector. Companies that specialize in direct-to-chip liquid cooling and immersion cooling technologies are quietly receiving massive injections of private and public capital. The retail market doesn't talk about liquid cooling. It's not glamorous. It doesn't make for an exciting headline on CNBC. But without it, the entire AI ecosystem physically melts down. This is how the omniscient investor operates. They do not look at the shiny object. They look at the shadow cast by the object. They ask themselves, what must be true for this narrative to continue? For AI to continue, data centers must be built. For data centers to be built, the grid must be upgraded. For the grid to be upgraded, copper must be mined. For the processors to run, liquid cooling must be installed. And for all of this to happen, capital must flow out of the overvalued software layer and into the undervalued physical layer. This is the geo-arbitrage angle. The shift is not just happening across sectors, it is happening across borders. The United States is currently facing massive regulatory hurdles when it comes to permitting new energy infrastructure and data center construction. The grid is heavily regulated, and building anything takes years of legal battles. So, where does the capital go? It flows to the path of least resistance. We are tracking massive institutional movements into Southeast Asia and parts of the Middle East. Regions where energy can be secured quickly, where land is cheap, and where governments are offering aggressive tax incentives to attract the infrastructure layer of the digital economy. This is a global supply chain realignment. We are seeing sovereign wealth funds partnering with private equity to build hyperscale data centers in emerging markets, effectively offshoring the physical footprint of artificial intelligence. If you are a retail investor sitting in North America or Europe, you are likely completely blind to this capital flight. You are watching the domestic stock market tick up and down, completely unaware that the foundational infrastructure of the next decade is being constructed on the other side of the planet. So, how do you position yourself? How do you stop playing the retail game and start trading alongside the institutions? First, you must detach from the momentum trap. Stop looking at what has already gone up 300% in the last 12 months. The easy money in the semiconductor trade has been made. To enter now is to assume maximum risk for minimum reward. Second, you must start screening for industrial efficiency. Look at the balance sheets of the companies that build the transformers, the thermal management systems, the specialized construction firms that actually pour the concrete for hyperscale facilities. Third, follow the energy. Look at the utility companies that operate in regions with favorable regulatory environments and heavy concentrations of tech operations. Look for the operators that are actively securing long-term power purchase agreements with major tech firms. The market is a machine. It is designed to transfer wealth from the impatient to the calculating, from those who react to headlines to those who read the underlying data. The AI revolution is not ending. It is simply maturing. It is moving from the realm of software and theory into the realm of steel, copper, and electricity. The smart money has already made their move. The rotation is active. The only question is whether you will adapt to the physical reality of the market or continue to buy the illusion at the top. This is the institutional view. Do not let the noise distract you. Look at the data. Follow the infrastructure. And position yourself before the rest of the market wakes up to the math. We will continue to monitor the filings and the capital flows as the quarter progresses. If you want to maintain your institutional edge, make sure you are subscribed. Until next time, trade the reality, not the narrative. Capital has no allegiance to a flag. Capital operates purely on the laws of physics. It flows aggressively and silently to the path of absolute least resistance. In the first chapter of this series, we established that the artificial intelligence revolution has hit a physical wall in the West. The American power grid is exhausted. Land in premium technological hubs is prohibitively expensive. And the regulatory red tape required to build a single nuclear-powered data center can trap a developer in litigation for a decade. But the algorithms cannot wait a decade. The models must be trained today. The data must be processed tomorrow. So, where does the smart money go when the United States cannot physically accommodate the future? They execute the largest geo-arbitrage trade of the 21st century. They offshore the physical footprint of the human mind. Welcome to Chapter 2. Today, we are tracking the massive, multi-billion-dollar capital flight leaving Silicon Valley and landing in the jungles and megacities of Southeast Asia and the Indian subcontinent. If you are a retail investor staring at the New York Stock Exchange, you are watching the scoreboard. But the actual game, the pouring of the concrete, the laying of the submarine cables, the massive deployment of institutional dry powder, is happening 8,000 miles away. To understand this shift, you have to understand the fragility of the current geopolitical map. For the last 20 years, the technology supply chain relied on a single, highly concentrated choke point, Taiwan. The vast majority of the world's advanced semiconductors are manufactured on an island that is constantly under the shadow of geopolitical conflict. The institutional money, the sovereign wealth funds, and the apex private equity firms realized that concentrating the entire future of artificial intelligence in the South China Sea is an unacceptable risk. This birthed the China Plus One strategy. But in the era of AI, it has rapidly evolved into a complete structural realignment. The institutions are not just moving the manufacturing of the chips, they are moving the environments where the chips live. They are moving the data centers. Let us look at the epicenter of this silent boom. A place the mainstream financial media almost never mentions. Johor Bahru, Malaysia. To the untrained eye, it is simply a border city sitting just north of Singapore. But to the algorithmic trading desks and infrastructure funds, it is the most valuable technological real estate on the planet right now. Singapore is the financial capital of Asia. It has the banking infrastructure, the security, and the global connectivity. But Singapore is an island. It has no available land, and its energy grid is tapped out. The Singaporean government literally placed a moratorium on building new data centers because they consume too much of the country's electricity. So, The institutions simply cross the bridge. In Johor Bahru, land is abundant. Energy is cheap. And the Malaysian government is offering incredibly aggressive tax incentives to any institution willing to pour concrete. Over the last 24 months, we have tracked billions of dollars flowing from Western private equity into Malaysian infrastructure projects. They are building hyperscale facilities that rival anything in North Virginia or Texas. They are laying massive, high-bandwidth submarine cables directly from the Malaysian coast across the Pacific, linking this new digital fortress directly to the west. This is the essence of geo-arbitrage. You take the high-margin intellectual property of an American tech giant, and you power it using the low-cost, heavily subsidized physical resources of an emerging market. But Malaysia is just one node in this new global network. Look slightly further north, to Thailand and Vietnam. As we discussed in Chapter 1, artificial intelligence requires extreme thermal management. The transition to liquid cooling and immersion cooling is non-negotiable. The smartest money is currently financing the relocation of these highly specialized thermal manufacturing supply chains out of mainland China and into industrial estates outside of Bangkok and Ho Chi Minh City. The tycoons and the legacy conglomerates of Southeast Asia, families that made their fortunes in agriculture, real estate, and traditional telecom, are suddenly partnering with Western tech behemoths. They are forming joint ventures, blending local political dominance with institutional Wall Street capital. The retail investor cannot easily access these private joint ventures, but they can see the ripples in the public markets if they know where to look. The local utility companies in Thailand and Vietnam. The regional construction firms that specialize in industrial cooling. The telecom companies that own the fiber optic rights of way along the highways. These entities are experiencing a silent renaissance, fueled entirely by Western capital desperate for a home. And then, there's the engineering superpower of the East. India. While Southeast Asia is absorbing the physical hardware and the data centers, India is absorbing the secondary processing and the human capital required to maintain the AI models. Global capability centers, massive, highly secure campuses built by American banks and tech firms, are expanding aggressively across Bengaluru, Hyderabad, and Pune. But these are no longer the simple call centers of the early 2000s. These are elite compounds housing thousands of data scientists, machine learning engineers, and algorithmic architects. The institutional calculation here is purely mathematical. Why pay an engineer in San Francisco $300,000 a year when you can hire a brilliant, hungry engineer in Hyderabad for a fraction of the cost and plug them into the exact same cloud infrastructure? This is not outsourcing. This is absolute systemic integration. The Western markets provide the capital and the foundational AI models. Southeast Asia provides the land, the power, and the cooling. India provides the mass engineering talent to refine the algorithms. It is a perfectly constructed, globally distributed machine. And the American retail investor, sitting at home watching Jim Cramer on television, is completely disconnected from this reality. They are buying the overvalued software stocks at the absolute peak, while the underlying foundation of the technology permanently leaves their hemisphere. So, how does the omniscient investor extract alpha from this geographical shift? You must expand your horizon beyond the S&P 500. You look at emerging market infrastructure ETFs. You look for the publicly traded Asian conglomerates that are signing 50-year land leases with American cloud providers. You investigate the global submarine cable operators, the companies that actually own the fiber optic lifelines connecting these Southeast Asian data hubs back to the United States. You stop betting on the software and you start betting on the bandwidth. Because the data has to travel. If a large language model is housed in a hyperscale facility in the Malaysian jungle, but the user is asking the question from an office in New York, the latency must be near zero. The companies that manufacture, lay, and maintain the deep-sea cables that cross the Pacific Ocean are currently sitting on a monopolistic gold mine. The institutions know this. They are buying up the capacity before the cables even touch the water. This is how you trade the institutional view. You do not chase the echo. You find the source of the sound. The AI revolution has physically relocated. The capital flight is complete. But building the data centers and laying the cables is only part of the equation. Because even in the jungles of Southeast Asia, even with cheap land and aggressive governments, you cannot escape the fundamental laws of chemistry. These facilities require raw materials. They require elements that are becoming increasingly rare and increasingly hoarded by hostile nations. To power the machine, the institutions are currently engaging in a terrifying game of resource warfare. A game that is manipulating global commodity markets and setting the stage for a massive supply shock. That is the final piece of the puzzle. The raw material endgame. And that is exactly what we will decode in Chapter 3. Do not look away from the map. The lines are being redrawn. We will continue to track the capital. If you want to maintain your institutional edge, make sure you are subscribed. Until next time, trade the reality, not the narrative. There is a fatal flaw in the mathematics of the Silicon Valley elite. They operate under the assumption that software is infinite. That code can be scaled infinitely, and that the cloud is an invisible, weightless realm. But as we have established throughout this series, the cloud is heavily tethered to the earth. In Chapter 1, we exposed the capital rotation out of software and into the power grid. In Chapter 2, we tracked the geo-arbitrage shift, following the billions of dollars relocating the physical infrastructure of artificial intelligence to Southeast Asia and India. But building a hyperscale data center in the Malaysian jungle or laying a 10,000-mile submarine cable across the Pacific Ocean brings us to the ultimate, inescapable bottleneck of the global economy: chemistry. Welcome to Chapter 3, the conclusion of our thesis on the AI Capex Rotation. Today, we are stripping away the technology and looking at the dirt. We are decoding the raw material endgame and the silent resource war that institutional money is currently waging behind the scenes. If you want to understand where the greatest asymmetric wealth will be generated over the next decade, you must understand that the AI revolution is actually a mining revolution in disguise. Let us begin with the nervous system of the digital age. Copper. You can write the most elegant, advanced artificial intelligence algorithm in human history. But if you cannot transmit the electrical current from the power plant to the processor, your algorithm is entirely worthless. Electrons do not travel through the air. They travel through copper. The electrification of the global economy was already straining the world's copper supply before artificial intelligence arrived. Electric vehicles, solar grids, and wind turbines all require exponential multiples of copper compared to traditional combustion technologies. But the AI data center build-out has completely shattered the supply and demand models. A single, gigawatt-scale data center requires thousands of tons of raw copper for its internal busbars, transformers, and cooling systems. Now, factor in the thousands of miles of new high-voltage transmission lines required to connect these new, remote data centers to the global grid. The institutional math is terrifyingly simple. The world is currently consuming more copper than it discovers. You cannot simply write a line of code to create more metal. A Tier 1 copper mine takes an average of 15 to 20 years to discover, permit, finance, and bring into production. The capital expenditures required are staggering, and the environmental regulations in the West have made it nearly impossible to break new ground. While retail investors are aggressively bidding up the price of software companies, the apex predators of global finance, the massive commodity trading houses and sovereign wealth funds, are quietly buying up physical stockpiles. They are accumulating equity in the global mining majors. They are front-running a structural supply deficit. They know that when the tech giants realize there is not enough conductive metal on Earth to build their projected data centers, the price of copper will decouple entirely from historical norms. The institutions are not buying paper contracts. They are buying the physical reality. But copper is only the transmission mechanism. We must return to the source of the power. Which brings us to the most controversial and highly lucrative institutional trade on the board: uranium. In the early days of the green energy transition, the political narrative dictated that wind and solar would power the future. But the institutions knew the physics did not add up. Data centers operate 24 hours a day, 7 days a week, operating at maximum thermal capacity. They require what is known as baseload power, an uninterrupted, massive, and entirely predictable flow of electricity. The wind does not always blow. The sun does not always shine. And battery storage technology is mathematically incapable of bridging the gap for a gigawatt-scale facility. The tech giants have quietly realized this, and they have panicked. This is why you are seeing the largest technology companies in the world quietly lobbying for the nuclear renaissance. They are actively funding research into small modular reactors and signing exclusive power purchase agreements with existing nuclear fleets. But a nuclear reactor requires fuel. It requires yellowcake. It requires uranium. For the last 10 years, the uranium mining sector was a wasteland. Prices collapsed. Mines were placed into care and maintenance. Exploration budgets were slashed to zero. Now, the demand is violently snapping back. And there is no inventory. The smartest money on Wall Street has spent the last 36 months quietly accumulating physical uranium trusts. They are buying the raw, unenriched commodity and locking it away in vaults. They are starving the spot market, squeezing the utility companies that are suddenly desperate to secure fuel for the next decade. When you buy a top-tier uranium miner or a physical uranium trust, you are not betting on a tech company's earnings report. You are holding the ultimate leverage over the entire AI ecosystem. Without baseload nuclear power, the data centers go dark. Without uranium, there is no nuclear power. This is the raw material endgame. But it goes beyond supply and demand. It enters the realm of global security. The retail market still views the economy through the lens of free trade. The institutional market views the economy through the lens of resource warfare. The vast majority of the critical minerals required for the technology transition, the rare earth elements for magnets, the graphite for batteries, the processing capacity for copper and lithium, are heavily controlled by Eastern powers. China does not just mine these materials, they absolutely dominate the global refining and processing choke points. As the geopolitical fracture between the East and the West accelerates, these commodities are being weaponized. Export quotas are being implemented. Supply chains are being deliberately choked. The Western institutions realize that relying on hostile nations for the foundational elements of the digital economy is a catastrophic vulnerability. This is triggering a massive wave of capital into friendly shore mining and refining operations. Billions of dollars are being deployed into Canada, Australia, and South America to rebuild a sovereign supply chain. The smart money is financing the companies that can pull the metal out of the ground and refine it without asking Beijing for permission. So, we have reached the end of the roadmap. Over the course of this 3-part series, we have mapped the exact trajectory of institutional capital. We watched the money flow out of the overcrowded, overvalued software layer. We watched it move into the power grid, the thermal cooling systems, and the heavy electrical equipment. We tracked its flight across the Pacific, landing in the hyperscale data centers and engineering compounds of Malaysia, Thailand, and India, capitalizing on the geo-arbitrage of cheap land and cheap energy. And finally, we traced it down into the bedrock, into the copper, the uranium, and the strategic resource wars that dictate the terms of human progress. This is how you build an institutional portfolio. You do not chase the endpoints. You own the foundation. If you want to survive the coming market rotation, you must ruthlessly audit your exposure. You must ask yourself if you are holding the assets that are priced for perfection or the assets that are priced for scarcity. The technology will continue to evolve. The algorithms will become smarter. The software will rewrite itself. But you cannot rewrite a copper atom. You cannot digitize the uranium isotope. The physical world is reasserting its dominance over the digital illusion. And the wealth transfer from the ignorant to the informed is accelerating. This is the institutional view. Stop playing the retail game. Stop trading the news cycle. Look at the balance sheets, follow the supply chains, and anchor your capital in the physical reality of the market. We will continue to decode the 13F filings, the capital flows, and the shadow markets as this supercycle unfolds. If you want to maintain your institutional edge, make sure you are subscribed. Until next time, trade the reality, not the narrative.